Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host Nina Mishra. In this episode, we are talking about carbon credit markets. And we know that shipping, carbon credits, and tin were the best performing areas of 2021. Now, the breakaway dry bulk shipping ETF, that you can symbol BDRY, that was up almost 250% last year because container shipping rates surged because all these supply chain disruptions around the world, which were caused by the pandemic. Now, we had the manager of BDRY on the podcast in May last year. So if you're interested, you can listen to that episode. Today, we are focusing on carbon credit ETFs, as I mentioned. And my guest today is Luke Oliver, Managing Director and Head of Strategy at KraneShares. So the KraneShares Global Carbon ETF, ticker symbol KRBN, that was up more than 100% last year. So we will talk about that ETF and also more about these carbon credit markets and how exactly these work. So joining me now is Luke Oliver. Luke, welcome. Great to have you on the show.
Thank you, Nina. It's great to be on here again.
So we know that the governments around the world are focused on this goal of net zero emissions by 2050, which is set by the 2015 Paris Agreement. And we also know that some of the largest companies have voluntarily committed to a net zero emissions target. For example, Microsoft plans to be carbon negative by 2030, and Apple, which is already carbon neutral for corporate emissions worldwide. Apple plans to bring the carbon footprint of its entire supply chain and products negative by 2030. So these companies are investing in renewable energy and carbon capture technologies, and sometimes they use carbon offsets too. And another way for companies to manage their carbon footprint is to buy and sell emission allowances. So basically, there are two types of carbon markets that exist. One is the voluntary market, and the other one is the regulatory compliance market. And I don't think investors really understand. They are not very much familiar with these carbon markets. So to start, I'd love for you to, explain what are these carbon allowances and carbon offsets, and what exactly are the differences between the two.
Yes, and that's a huge question, and it's interesting because we get this question a lot because the compliance markets, so the mandatory markets, the sort of regulated markets, are by far the largest, most liquid segment of the market. And yet when people think of carbon allowances or carbon offsets, they think about trees and natural solutions, and they're two very different things. So I'll start with carbon offsets. Carbon offsets, voluntary market, and that is where companies, you mentioned Microsoft and Apple and others, are buying offsets that are essentially funding the growing of trees or various programs. They take a lot of different forms, whether it be renewable energy programs, cook stove programs, turning methane into carbon dioxide, you name it, any way where someone is able to prove and evidence that they have offset carbon or create something that is sinking carbon, they can then sell that as an offset. So there is a voluntary market where companies choose to buy these offsets, and those offsets result, hopefully, in some additional carbon capture through one of the many means that this can happen. Now, that market is interesting and it's voluntary. So the demand is voluntary. And the question of whether that demand exists at every price point is a big question. Also, the supply of offsets it's a very diverse market. There's no standardization. The regulation and transparency there is potentially not as clear, but that's changing and getting better. And there are registries that are putting minimum standards in. So that's getting better. But I look at those markets as having unclear supply, and the amount of supply is completely unclear, and how much that supply grows is hard to determine, and then the demand is somewhat hard to determine. Regardless, I think that market is going to grow and the prices will rise over time, but the fundamentals are quite hard to pin down in that market. Now, the other market is the compliance market, and the products that we run currently focus on the compliance markets. These markets have very clear, tangible fundamentals. That is that these are government run, so the European Commission runs the European Union's program. California Air Resource Board runs one of the other big programs that runs out of California. There's the RGGI, there's the UK program, South Korea has a program, China has a program. These are government run, and the government sets a cap on how many allowances, each worth 1 ton of carbon, can be sold each year at auction. And then the entities within those regions absolutely mandatorily must purchase those allowances in order to pollute and continue their business. So you have very clear, transparent supply, and that supply is declining, becoming more scarce over time. And you have buyers' demand that is inelastic because they must buy them. And what we hope over time is that as supply reduces, demand reduces too, because demand reducing means emissions are coming down. That's what we want. But the basic thesis around the compliance markets is that supply will fall faster than the demand can fall, and therefore the price will rise. And now, there's the difference between the two. One has very tangible fundamentals, one a little bit less so. But the objective is somewhat similar in that if there is a price on carbon, companies will seek to find more efficient ways to do things that results in less emissions, because it will reduce their exposure to this rising price of carbon. And that really only happens in the compliance market because they must purchase it. Whereas in the voluntary market, if you don't need to purchase it, you might not. And therefore, it's not really an incentive to clean up your act, as it were. That said, it's absolutely brilliant that companies are offsetting their carbon, and others are, and in some cases, participating in both compliance and voluntary markets. So a long-winded answer, but essentially what we focus on is compliance markets, because these are the markets that are forcing companies to reduce emissions, not just buy offsets that allow them to justify emissions, if that makes sense.
Yes, it does. So talking about the voluntary markets, so basically if I fly and then I feel bad about the carbon impact of my travel, then can I buy some carbon offsets? I've seen that some airlines give some sort of an option to buy carbon offsets for people who are flying.
Yeah, and yes, you can. And some, I think some websites, e-commerce websites, when you buy something, they offer, pay an extra few dollars and they'll offset the carbon for packaging and mailing the goods to you. It's relatively easy. Airlines do the same thing, somewhat relatively easy to do that. But what I should really say up front is that entire offset market is about $1 billion market. Sounds big. The compliance market, just in the major 3 or 4 markets, so California, Europe, RGGI, the UK, they trade at about 600 billion in terms of dollar value of trades in the futures market on those. So really, that market is growing. But the idea of people offsetting their personal offsets, it's a small and growing market, but by a huge magnitude, the compliance market is the real market. So I guess I think that's the key market. That's where people really need to focus on as an asset class, is the compliance market.
Right. It's fascinating. And these are such big markets, and many investors are not even familiar with these markets. So let's talk a little bit more about these markets. Please tell us how exactly this cap and trade system work. And you mentioned markets in the European Union, California, South Korea, China. So how big are these markets? And do you expect more markets also to come online in the coming years?
Yeah, so there's definitely going to be more markets. There's markets springing up in various different jurisdictions, and the existing jurisdictions are growing. I mean, China only launched last year in 2021, and so that will be arguably the biggest market in the world, and that's only really just getting started. South Korea, you mentioned, it's a very established market, but it doesn't have a liquid futures market, so it's not that accessible. But the European Union is the big one. It's a huge market. It has an annual cap of about 1.6 billion tons of carbon. Those tons of carbon each trade for about $100 each, to give you a little bit of context on the size. And then, as I mentioned, huge liquid futures markets that trade around, and options market. And then we manage a fund that has about 1.65 billion in assets that are trading in these markets. As well. So we actually have the largest fund ETF in the space, the only ETF really that provides exposure to these carbon markets. So we certainly think they're growing. You look at a program like California, that has expanded to include some Canadian provinces, potentially adds additional US states. You have RGGI, Regional Greenhouse Gas Initiative, so shortened to RGGI, is the East Coast version of the program, and that runs all of the states from Maine to Virginia, and potentially Pennsylvania joins. And Pennsylvania, being a huge coal producer, a huge energy producer, will almost double the size of that program. So there's growth of different geographies. There's expansions of existing geographies. There's also the industries covered. So RGGI only covers power generation, whereas California and Europe cover, numerous industries, and some of the big industries, steel, cement, glass, power generation are the big ones. So even within those markets, maybe new industries get added. The Europe, is the conversation always centers around, is transportation included? Does aviation go into the European program, or does it have its own global program? So there's lots of growth potential. And of course, the other growth is the price. If you look at the prices in these markets, they range quite broadly. Europe and the UK are around $100 a ton. California is only 33, and RGGI is only 14. Those are very accessible markets. And then as you go, you look at China, it's around $7 a ton. So it really varies. And of course, offsets, while I don't bucket them with these compliance markets, those prices range from a couple of dollars up to $30. And I think the average is about $15 at the moment. So real dispersion of prices. And that's why I think it's important to try and simplify this and create a single global price, which is what our objective is as an asset manager.
Right. It's a fascinating area. So who are the entities that participate in these markets? And you mentioned carbon pricing. So how exactly these emissions are measured? I have no idea. How do you measure the carbon emissions by a company? And how does that company go and buy these allowances? These are sort of pollution permits, right?
Essentially, they're pollution permits, and it's funny. That was one of my first questions as well. Is how do we measure them? And it's actually not that difficult. The most companies, it's somewhat formulaic. You look at if you're a power company, how much coal did you buy? How much energy did you put into the grid? And it's quite easy to back into what your emissions were. And then you have approved, sanctioned reviewers that then review those numbers, and those reviewers, are registered with whether it be California Air Resources Board or the European Commission. And so I think of it a little bit analogous with the way taxation works, in that you file taxes with your income and what you think you owe and what write-offs you have and everything else, and you feed that in, and then you pay your taxes. In this case, you buy the allowances and redeem the allowances in line with the amount of emissions that you put out, or in the tax analogy, you pay as much taxes as you should. And of course, that means that, and the reason I use that as an analogy is that it works, it's widespread, it's systematized. Does it mean some company somewhere is underreporting and hasn't been caught? Maybe. In the same way someone isn't paying the taxes they should, but there's the same sort of audit process that works, and by and large it's a pretty solid process, and it's high integrity. So that isn't the difficult part of this.
So now let's talk about your ETF that you mentioned. KRBN is the ticker symbol. Mm-hmm. And this was one of the best performing ETFs last year. It was up more than 100%. And because of its excellent performance, it also gathered over $1 billion in assets last year, I understand. So this uses futures, not the underlying carbon credits. So tell us more about this ETF, how it is structured, and why does this ETF utilize futures and not the underlying carbon credits?
Well, there's a few things there. So one, I should add, the flows, much of those flows came as the fund performed, and I certainly wouldn't want to characterize it as people chasing the returns, more so that this is a really important story. This is an emerging asset class. There is this somewhat fascinating asymmetry in the potential, because you have this central bank type function with the entity that runs the program. They're trying to reduce supply. It's almost like a central bank that's on a tightening cycle. And so people are really picking up on this. We're seeing a lot of family offices, a lot of institutions really picking up on this. And so that's kind of what we put the flows down to. Now, as for why we structure it the way we do, this is a 1940 Act ETF. It's you buy this ETF, it's reported on your 1099. This isn't anything unusual, but to put carbon allowances into a 1940 a securities fund isn't a natural fit. And so what we've applied is this sort of fairly standard structure for getting a sort of non-standard exposure into a 40 Act ETF, and that means getting exposure via those futures. And there's a lot talked about, and increasingly people are talking about physical versus futures. And the reality is, this is not oil. We don't have an egregious contango in the curve that means holding futures is too expensive. Although we should always note that the value of the physical versus the future, that curve is always being arced. So if there is a 10% spread, that's because it costs 10% to move that oil from A to B, and that price is somewhat fair. So we hold the futures because it's the only liquid, transparent way to get access to these markets. Now, Europe has almost daily auctions, so it's quite transparent from that perspective. The other markets, the US markets, have quarterly auctions. Secondly, the secondary market in these allowances is somewhat opaque. It's not very transparent. It happens bilaterally. It's not exchange cleared. And so that's not ideal for us structuring our product. So having a liquid vehicle with a daily settlement is exactly what you need when you're structuring a product. And so that's why we use the futures. Now, the thing that we're starting to hear is people saying, oh, well, we want physical because physical is more real than holding futures. And there's a little bit of a fallacy there in that a lot of the funds and products offering exposure to physical will use the futures to get long and then take delivery. And so anyone concerned about carry costs in futures, you're experiencing a material portion of that in the so-called physical funds anyway. And so there's a real sort of misconception there. Secondly, is this isn't a commodity. This is a very much like a financial instrument. So if you take the European market, the difference between the physical and the futures, a 1 year out future might trade 60 basis points higher than the spot, and yet it's more liquid. You have a transparent fix, and I mentioned the volumes on these things. This is huge, and so what you make up in liquidity and transparency at 60 basis points is very low. Now, not some markets are wider, and that's an area we spend a lot of time educating clients on. But essentially, being long the futures is getting the market longer, and all roads lead to Rome. These aren't easy to hedge. These don't correlate with anything else. So if you're long a future, someone somewhere is either holding the physical, or they're a natural short, which means you're taking that downward pressure out of the market. So you're net making the market long. Your impact on the market is the same. And I know there are some products out there where people are talking about physical as somehow permanently removing the carbon from the market, but they're not. If it's a product that someone's marking to market as an investment, there's an intention to sell that at the end. And the long and short of this is when getting exposure, the futures and the physical represent essentially the same experience, with pros or cons around one being more liquid, one potentially doesn't have roll yield, but then it doesn't have liquidity. And so it's much of a on balance, there really isn't a big difference. And this for us, having when you weigh all of those things up, having the liquidity and the transparency gives futures the edge for us, and that's why we're holding futures.
Makes sense. So KRBN, which is the KraneShares Global Carbon ETF, this is your most popular ETF. In fact, it is the most popular carbon ETF. You expanded the carbon suite last year, and I think that was in October. And you also launched the KraneShares European Carbon Strategy ETF. The ticker symbol is KEUA, and you launched another product focused on California. It is the KraneShares California Carbon Allowance Strategy ETF. Ticker symbol is KCCA. So tell us a little bit more about these products, global versus those focused on these regional markets, and how should investors decide which is the right product for their portfolio? Should they buy the global ETF or the European ETF or the California ETF? Give us some. Tell us how to decide.
So we've met clients who have very strong opinions that they only want Europe because it's the largest, most liquid market. In some cases, they see the performance being so strong that they feel like that's where they want to be. But they see the size and liquidity, and they think that's the main market, and therefore should be the core of their allocation. Likewise, we've seen others who maybe are more US-centric in their investments, and they think and see the risk return on California might be more interesting. There might be a catch-up trade, maybe in their opinion, to Europe, and maybe they see Europe as having already performed and maybe is less likely to perform. And so we see people on both sides of the fence. And so we created KEUA and KCCA as ways for people to express those strong views. Our view is that the basket approach with potential overweights to one or more of those markets is the right way to do this. And so we personally very bullish the California market, given where it's priced, the fact that the program might be getting tightened up in 2022, the fact that there are some analogous patterns between Europe and California, which California trading at $33 could have some upside here, or faster, greater upside in the short term relative to other markets. But we don't think the standalone California, completely standalone, is ideal from a risk perspective, given how volatile these markets are. So we think our preferred allocation right now is a core position in KRBN. You get the global, you get 4 different markets, and they are uncorrelated with each other, and that's made for KRBN to be much lower vol than any of the individual parts. And that's why we really like the basket approach. And then we favor an overweight right now to California. So be long California, but do so with the diversification of that whole basket. So we definitely can't stress it enough. We like the basket. We also like an overweight to California. And I should say that I'm not including Europe there, but KRBN is 60% Europe. And so you're getting your European exposure through KRBN at that point. So that's just how we look at it. But we certainly have some clients who are just Europe only, and we certainly have some clients that are just California only. And all of these, we're supportive and bullish on all of the markets in these funds. But if I had to boil it down, I like the basket, and I like a smaller overweight to California alongside that.
And that's quite helpful. So as I mentioned, the ETF KRBN, that was up more than 100% last year. So was there any specific reason why these carbon allowances did so well last year?
I mean, there's lots of factors, but the main factor that drove the performance and will continue to drive the performance is the fact that these markets are tightening. Take the European Union. There was an excess supply of these allowances for the last 10 years. Since 2009, there's been too many of these allowances in the market. And every year they auction new allowances, and the old allowances haven't been used up. And so there was this glut of supply. The European Commission, and they sort of doubled down on this in 2021, is they have increased the reduction in the cap each year. So it used to be a 2.2% reduction each year. It's now going to be a 4.2% cut each year. So the supply coming to market is going to reduce. And then even more powerful than that is, and this is the big one, the market stability reserve is going to remain in place, and that is going to buy 24% of each new auction, meaning that the cap is going to be, they're only going to auction 76% of the cap each year, which will force the companies to use up the inventory in the market instead of just buying at auction. And so what that has done over the last year or two has drastically reduced the amount of allowances in the market. So supply has come down a lot. And so we've gone from being oversupplied to getting down now to about 1 year's worth of supply in the market, and then 76% of a year's supply coming to market each year. So it's at this rate, we're really going to end up over the next couple of years, not with a drastic shortage, but with a very tight demand supply dynamic. And it's that's driving the demand in price, because people are seeing where these prices could go, and that's suddenly creating price discovery. If you didn't worry about this price and you just bought these offsets and there's ample supply, there was no real upward pressure on the price. Suddenly people are realizing there's not enough of them and they're going to get expensive, and therefore people are discounting those projections back to today, and the price is rising. And when the California, very similar thing happening. We spoke to some California entities at the end of last year, and this year when they went to buy their allowances, they realized how much more expensive they had got. And what if you think about a power station buying coal, that used to be the most important thing that they needed to buy was coal. That was the whole point of their business. Now they need coal and allowances to keep doing that. And so in the same way that energy companies trade power and gas and ensure they have security of supply, they need to do the same for carbon allowances. And so carbon allowances now kind of are leaping forward into that price discovery mode. And I think that's where we're seeing this bullish shift. So same thing. The management of these programs is engineered to support the price, and the supporting the price means cutting emissions. So as you mentioned right at the beginning, the global focus on emission targets, this is how countries are going to meet their emission targets, by getting the price of carbon higher and supporting it. And so what we offer here in KRBN is being long carbon. And so as a result, it's that management that is going to be the main driver. We'll have volatility for 10 different reasons, and we could talk about some of those, but the main driver here is the reduction in supply versus somewhat inelastic demand.
Very interesting. Now let's talk about the investment case for these ETFs. How do you view them in a portfolio? Now you mentioned that this is a unique asset class, which is not largely correlated with other asset classes. So should investors use these products for diversification benefits, or for inflation hedge, or for just for socially responsible investing? And you also talked about these demand and supply imbalances, or should investors invest in these asset classes in this asset class because of that market tightening?
Yeah, so the market tightening is the basic premise for why people are bullish carbon allowances. As for what this means for your portfolio, all of the above, everything you said is we've had investors that have their primary focus on some of the things you said. So kind of to recap those, initially people are interested because they see this potential for asymmetry in the return. Now we have to have our eyes open that these are volatile. However, they have great diversification benefits, as you mentioned. The basket is about a 0.38 correlation to US equities, so very low correlation. And so you have something that has potential to have significant alpha based on the dynamics we talked about. It does so, and because of this controlled reduction in supply, that controlled reduction in supply doesn't correlate to anything. That's flat line, linear reduction over time. And so that's what creates a diversification benefit. So alpha potential is one. The diversification benefits that come with it certainly supports the first one, but some people see this as an alternative, are concerned about equities, about fixed income, and they see this as a great diversifier. Inflation, or I also think about just an equity hedge, is as the price of carbon rises and rises in more markets, you may see a drag on some of the equities you hold as they have to buy these allowances and they might not be able to hedge them successfully, or at least it creates risk or volatility in those equities. So it makes sense to be long carbon alongside equities, which everyone will obviously be still long equities at some material part of their allocation. And then if the price of carbon starts being passed on to consumers, and even though that's not ideal, of course it's going to happen. Everything's always been too cheap because no one's paid for the carbon. Now they have to pay for the carbon. Prices may be higher, and they should be higher, unfortunately. And so that means you can be long the agent of inflation. So it's not an inflation hedge. This could be the thing that causes some inflation. So you can literally be long the rising price of carbon, which itself might feed into inflation. And then all of that said, I think all of those are very strong, pure portfolio dynamics, positive characteristics that this can bring to a portfolio. It's clearly feeds. It's not, you can't say ESG. It's not, you can't score it as an ESG company. It's carbon. It's literally the price of carbon. But it is a policy tool used by governments to reduce emissions in their geography. So there's a lot of governance there. It's certainly environmental because you've got this. This is it's kind of, it's impactful. You're supporting the liquidity and the price of carbon, and the higher the price of carbon is, and the more robust these markets are, the greater the impact on reducing emissions is. And this is more than anything else driving down emissions in the economies that are covered by it. So all of the above: performance, potential, liquidity, diversification, inflation hedge, and impact and aligned with ESG investing.
Excellent. Now, switching gears a little bit, I also wanted to talk about your China ETF. And KraneShares has an excellent suite of China-focused products. Your China Internet ETF, the ticker symbol is KWEB. That was one of the biggest ETF stories of 2021. And while your carbon ETF was one of the best performers, and it gathered a lot of assets because of its excellent performance, and you mentioned performance chasing by investors, KWEB was actually down about 50%. It was one of the worst performers, but this ETF had record inflows of $8 billion last year. So what was going on with this ETF? And I was also interested in your thoughts on China tech companies and this ETF in general. Last year they had a terrible performance, mainly because of regulatory crackdown in the country. So do you expect that situation to change this year? Should investors continue to buy the dip?
Yes. Short answer is yes. I should also recap that I was saying on carbon, investors were not chasing the performance. We actually had many of them investing on the thesis ahead of that performance, which was great.
Oh, okay.
But you make a great point, and with KWEB it was almost the opposite, that the performance was not strong because of political tensions, because of regulation in the US and in China that drove down the price of these Chinese stocks, and yet money kept coming into the fund. It was, as you said, it was about 8 billion in assets came into KWEB, and it's been such a fascinating story to watch because we've seen buying the dip, as you said. We also saw a lot of investors seeing the value of what KraneShares does, which is taking their individual holdings of Chinese ADRs listed in the US, seeing the political noise between China and the US, seeing Chinese regulation, seeing US regulation, and realizing that that's where the value comes from with a thematic fund like KWEB that takes our expertise and our market agility. And we saw a lot of people selling out of the JDs and the Alibabas and numerous other big names in that space, and then transferring into KWEB. So they were exiting the ADRs and then moving into KWEB. So there was, there's some tax loss harvesting advantages to doing that, but also moving into our fund. And that allows us then to navigate for them. Many investors don't have the capability to navigate through the changing regulation. So by putting their assets into the fund, that kind of outsource that to us. And that's what we're doing. And we're working very closely to navigate through the various changes in regulation and policy and doing that very successfully for investors. So that's been a big part of why investors have come to KWEB. Now, our outlook is very constructive on the China and the China tech space in particular. I mean, first of all, this sell-off has really widened the gap between US tech and China tech. I mean, the PE ratios on Chinese tech is around 18 versus 34 on US. So we're really seeing that cycle happening, that people cycling out of US tech and into China tech. We think we're going to see easing in China, which will be an incredible tailwind for Chinese companies. We also think that we kind of through the worst of the crackdowns and regulatory overhauls. And we should also note that despite what we kind of hear in the US, and it's always the coverage is always a little bit biased, we should point to a lot of the the so-called crackdowns were on places, like education that did need reform. And, dare I say it, some of these things that happen in China perhaps should be looked at over here as well in terms of, raising quality of life and, shrinking the spectrum from, haves and have-nots. So there's some interesting things going on there that while on the face of it create volatility, are long-term benefits, and that's a big one. There's a huge shift in China going underway right now, which is going away from growth at any cost, which is what we've seen in the past, to high-quality growth. So it's less about adding new users and getting more value from the existing user base. And so I think what we've got going forward is there's we've got valuations look good, we've got some great tailwinds in China broadly, and I think what we're going to have is quality growth over fast growth, and I think that's a really strong positive. And I think the diversification benefits of China versus US equities as well is going to continue to be a big driver. And as these economies potentially get further apart, that diversification benefit becomes even stronger. And let's not forget, KraneShares' absolute number one primary thesis is that every portfolio is underweight China relative to the fact that it's the second largest and one of the fastest growing economies in the world. And so we'd like to see allocations to China increase. And we think that we're on the cusp of seeing that happen. And that's always been our story from the start. And I think we're going to see it in 2022. We're going to see a real shift. And I think this those that have been long China for a long time, and then this huge inflow that we've seen, a lot of new money coming into China, I think this is going to, we're going to have an interesting year in 2022, both in carbon and China.
Definitely, both areas are very interesting, and we'll be watching them very closely this year as well. Luke, that's all we have time for today. Thanks so much for joining us.
Thank you, Nina.
So that was Luke Oliver of KraneShares. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast, and also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.